I think Sanjeev Prasad is with us, so let's not waste any time and go straight across to him. He's Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, great to have you with us here. Thank you very much for your time. You have a very close eye on earnings, and people we've spoken with so far have told us that even though earnings beats have been more than misses in the fourth quarter, it's not done very much for full year estimates, maybe because the starting point for FY24 was high. So we've still seen very small downgrades to full year Nifty estimates. For the broader market, maybe a little bit more. But what is your own assessment? 2 months of the first quarter 24 are behind us. How are earnings progressing in your view in relation to where we are in the market?
First of all, if you look at the fourth quarter FY23 results, we're not that great, honestly, even though there was a beat. If you look at Nifty 50 index, for example, net profits came about 7% ahead of expectations. But keep in mind the fact a lot of that was because of what I would say one-off factors. Something like, much lower tax rate in the case of Reliance, much lower overburden in the case of Coal India, very, very high refining margins in the case of BPCL and so on and so forth. So that's one reason why probably not seeing any upgrade as far as the street and our own numbers are concerned. And if you look at the EBITDA level, in fact, numbers are pretty much in line with expectations. It's about 2% higher compared to whatever estimates we had. So I guess that's what explains why we're not seeing that much only upgrade as of now. Now, coming to the broader economy, it's not as if we're seeing any great signs of revival so far. We are still hopeful that over the next few quarters we will start seeing consumption demand starting to come back. But so far the signs are not that great. In pockets we are seeing some recovery. But as of now, it looks like most of the earnings growth will be more driven by recovery in profitability rather than volumes. So fingers crossed, hopefully volumes also start coming back.
All right. Well, fingers crossed. A lot of stocks actually that have a rural exposure are hitting fresh 52-week highs today. So don't lose sight of that. There's Hero MotoCorp at a fresh 52-week high. There's Britannia at a fresh 52-week high. In fact, a lot of consumption plays, whether it is Bajaj Auto, whether it's Titan, all sitting at fresh highs. Sanjeev, hi, good morning. What does that tell us about the narrative in the market now? Do you think domestic focus, rural focus plays will now assume center stage, and is there more money to be made here? And if yes, what are the pockets that you like specifically?
What the market is focusing on as of now is some recovery in volumes going forward. So if you look at the last month or so, the focus has been improvement in profitability. And if you look at the fourth quarter results, in most cases, you saw significant improvement in gross and EBITDA margin on a sequential basis, which was expected because you have seen a big decline in raw material prices pretty much across the board, whether it's agri or related metal prices have come up very sharply. So that is a significant improvement in the gross margin, EBITDA margins in the fourth quarter. That will sustain or even probably go up higher in 1H FY24. So that is where the first round of excitement came on the consumption names. The second expectation, which is building in now, is some recovery in volumes going forward. So we are hopeful that volumes will come back, given the fact that in rural India, whatever damage had to happen because of COVID, high inflation, those are largely behind us. Jobs are starting to come back. People have gone back to the pre-COVID jobs. Urban-rural money transfer has started. Plus, you have seen significant increase in MSP prices announced yesterday. Hopefully, monsoon gods are kind. So, I would assume you will see some recovery in volumes going forward. Staples first, most likely, followed by discretionary. So that's what the market is focused on now. And I hope that's how things play out, because the problem over here is a lot of good news is actually getting priced in. That's where the challenge starts when it comes to valuation recommending stocks, But I would say the economic recovery is probably going to take shape, Whether that reflects in actual stock price movement or not, I don't know, because a lot of the good news seems to be already getting priced and well ahead of any improvement as of now.
Hi, Sanjeev. Good morning. Sanjeev, what about OMCs? I think that's a space you're liked, and valuation-wise, things look good. The problem is we're getting into an election year, and as reports indicated, and our colleague in Delhi reported that probably there could be a price cut that's coming. How do you approach the clutch of stocks? OMCs, by the way, they're the top losers today.
Well, I completely avoid them, to be honest with you. There's no way I can forecast the earning numbers of the OMC companies, given the fact that, you have just too much volatility in the earning numbers to start with on the refining side. And And our analysts honestly struggle to understand the kind of refining margins the OMCs are reporting, which are significantly higher than the global refining margins and even higher than Reliance's margins, despite the refinery is not being that complex compared to at least Reliance's refinery. So that's one mystery. And the second one is clearly on the marketing side, very hard to really forecast or make any estimates of earning numbers, because so far, given lower crude prices and no fat in retail prices, marketing margins have improved. But who knows? The government will take a stand that there is enough money on the table for the marketing company, so let's cut retail prices. Very hard, to forecast earning numbers of the company, which makes it doubly difficult to take a stock on.
Sanjeev, have you or your team looked at the broader market participation? I mean, it's getting quite not crazy, but it's up and up, right? Very buoyant market, and all kinds of stocks rallying, very varied, rich, deep. But again, I mean, some of it does make you sit up and take notice in terms of what is really going on. Any thoughts at all you can offer? Maybe you looked at it from a valuation point of view. It's just correction of that, or what's going on? Go on.
See, clearly the mood of the market is very bullish. As of now, what we are seeing is the market is latching on to any positive news in the short term. So we have seen the market getting very excited by improvement in profitability, but ignoring the weak volume part. Same way the market is very excited on the macro improvement, which is genuine. We have seen a big decline in inflation, interest rates are probably peaked out, current account BOP is looking very reasonable. So some grounds for optimism. But at the same time, the market simply does not want to look at any negatives which may play out, which is, maybe a much more muted recovery in consumption demand, which so far has been, pretty weak. And some of the medium-term challenges which come from the disruption side. Anyway, that's 4 years down the line, so people don't want to focus it as of now. So the mood in the market is pretty positive. We are seeing, pretty large flows on the passive side, both foreign and domestic, keep on coming to the market, which, results, people starting to take a more optimistic view across, the range of market cap. And in a way, there is some catch up on valuations. And the classic example is the banking sector, right? First you had the large cap moving up of late, particularly last 1 month or so, you had a lot of catch up trade happening in the MFI banks, for example, Bandhan or Equities or Jeevan, they all rallied very hard. Who knows if the mood continues, you could see that, that rally extending to the PSU banks also, because most of them are trading at about 0.62, one time, excluding SBI, that's where most of the PSU banks are. So, what we are seeing is clearly about broadening of market, participation, looking at the fact that the mood in the market is simply very optimistic as of now.
The mood in the market is very optimistic. I think all of us would, all the bulls would love to hear that. The stocks in focus right now are some of these platform companies. So let's just get them on board. Paytm is up almost 6%. Of course, BofA Securities has upgraded Paytm and has a huge target price of 855 rupees. But they speak about how the revenue momentum has suddenly started to pick up quite a bit. So look at that. Paytm. Zomato, by the way, is at a fresh 52-week high as well. And if you remember, in January of this year, Zomato was at just about 40 rupees, 45 rupees or so. It's trended all the way to almost 80 rupees now. Your thoughts here? Do you think this is the year where both profitability and stock action will come back in these platform companies? And if yes, anything that you like here?
Yeah, I don't know how quickly the profitability comes for this company, because, so far this company have been making losses only. But the clear message from the management has been, in most cases, has been that the focus has shifted to profitability rather than growth. So if the market, narrative is focused on profitability, the companies are in a position to deliver that. You'll stop growth for some time, you will become profitable. And to be honest, the company has also been working fairly hard on improving the profitability. So I wouldn't be surprised something like Zomato in maybe 4 to 6 quarter times, starts becoming actually profitable on the food delivery side. Maybe you have 2 players as a concentrated market. Average, AUV, if you look at it, about 4 rupees, not that difficult, get some, increase in delivery charges and, improve profitability. As long as, curtail back, aggressive spending related to expansion in new territories. So if that's the focus of the management and that's what the narrative in the market will like, I wouldn't be too surprised if this stock continue to do
Sanjeev, I want to just pull back a little bit, and this is a broader question once again, but important one. We had Rhythm Desai, Morgan Stanley, we were just talking about the wall of local money, right, which stands firmly behind, and there's always this domestic bid now for stock prices. And how large is that going to be a factor when we analyze all valuation and where stocks should be, what last 5 years, 6 years, 10 years valuations have been, where we are right now? Because this bid was not there 3, 4, 5 years ago. You combine that with foreign money, prices can stay, and if this is a longer theme which can run for years, then it's important to take note of it. How do you think about this?
Yeah, it's possible that, valuation will stay on the higher side for an extended period of time. If you look at the flow of money currently in the market is, if you look at the foreign side, that's positive. My understanding is a lot of that money is actually passive orientation. I guess this is more coming because of top-down macro improvement as far as India is concerned. And the fact that India is looking better compared to other emerging markets. So that explains why some amount of extra passive money is coming into the market from the foreign side. On the domestic side, anyway, you keep seeing the SIP money coming in, which has now gone to about 150 billion rupees, almost reaching $2 billion per month on a gross basis. Net numbers would be lower. And I'm not too sure, whether any of this money really focuses on valuations or return expectation, anything like that.
Exactly.
Just going in the respective valuations or fundamentals, money will probably keep coming in. Till that time, some disappointment sets in somewhere that, money is not getting made. Come to think of it, it's not as if the market has given significant returns over the last 18, 20 months. It's been pretty much in that range, right? 80,000 plus minus for the last 18, 20 months. So I don't know how much the SIP owners really look at the portfolio and try and assess, what is the IRR of the investment. That's the whole problem. And somewhere he was telling me that, the SIP owners are very happy because they are seeing accumulation in the portfolio. But that is only their money which they are adding every month, right? Every month we add 2,500 rupees. At the end of 12 months, it becomes 30,000 rupees, right? But what is the IRR of that money? Who is looking at it? That's where the problem is, I guess. I've spoken to a fair number of market participants, and that's the feedback I get that many of the SIP investors really don't understand the IRR concept actually.
Oh, absolutely. A complete masterclass needs to be done on that. Thanks for all of those truth bombs, Sanjeev. Appreciate it. Thanks for joining us on CNBC TV18. We will, of course, touch base with you again later. For now,